Hello, with me today I have Sam Wahab, Energy Analyst at SP Angel. Now Sam, the renewable sector has taken a hit this year. What's happened and why?
No, I agree. It's had a pretty rocky start to the year. I'd say it's probably down between 25 and 30% across many of the main constituents. If you compare that again to Q1 last year, where it had a bit of a boom, and that's where sustainability really moved up the global agenda for a lot of these companies, and they saw a massive headwind. And they reached their all-time highs. I say it's a number of issues, some of which are company specific, but many of which are through macro headwinds. In terms of where we were this time last year, there really was a scarcity of energy value in the market, and therefore we saw a bit of growth. And also there was longer term structural growth elements to the sector, which we all saw a benefit, well, the sector saw a benefit from. But since then, there are a number of issues that have come into play. Initially, really, is issues to do with supply chain management and logistics. The pandemic has caused a number of problems for businesses across many sectors, but particularly so here. I mean, in particular, if you look at some of the input costs that have to go into many renewables plays, whether it's hydrogen, wind turbines, solar, for example, we are seeing the raw material increases. So if you look at, say, wind turbines in particular, the costs of steel, iron, copper have all risen exponentially, and that's had a knock-on effect in terms of squeezing margins for many of the larger players. And that also goes to be said for fuel cell companies and other hydrogen players. So they've all seen their margins squeezed, IRRs reduced, and that's really led to a bit of a risk off from the market. And this is really an emerging sector in the first place. So it's there firmly in the higher risk bucket when it comes to investing. So we have seen a corresponding sell-off in a number of the stocks, the underlying constituents. In terms of where I see the sector going, I think there is a huge amount of upside, notwithstanding from this much lower base than what we realised last year. So there are a number of selective opportunities we see within the sector, and we see that trend starting to grow, especially as we are now into an environment where we do have much higher commodity pricing, and therefore it does come into focus where we're going to see these additional sources of energy for consumers.
Sam, is the renewables green energy sector more than just another investing fad? I mean, there's a lot of money being thrown at the sector, but is there a viable future for listed companies focused on wind, solar, water and other green energy sources?
Absolutely, there is. I mean, this is a sector that's certainly here to stay, and not only stay, it's going to grow exponentially over the coming decades, and also in the near term. Through the course of my work, I deal with investing institutions almost every day, and what I can tell you is that historically, there's been a lot of buzzwords in terms of where we are with ESG. There are a lot of acronyms, and it starts with HSE and then CSR, and now we're at ESG. And whilst the first two have slowly sort of ebbed away, I think ESG is certainly here to stay, in the sense that dealing with the likes of Amundi or BlackRock or Schroders, they've all got their individual ESG investing desks, sustainability investing desks, and dedicated green energy outlooks. In addition to, if you look across the public market space, there is a number of board changes where they are creating a focus on ESG compliance and compliance for the long term. So this is certainly not a fad. There's a huge amount of capital, as you say, that have been committed towards this. At the moment, this is only on the public company space, there is around $1 trillion globally solely committed to green energy and ESG compliance companies. We've also seen a divergence away from fossil fuel-led names, and these are big dividend players historically. The likes of Shell and BP and other European names like Eni and Total have historically had a sticky income investor base. That's starting to fall away in favour of more ESG compliant companies. So this is really a fundamental structural change towards green energy and ESG compliance. So certainly not an issue with regards to long-term sustainability of green energy. Also, if you look at where we sit today with issues with Russia and Ukraine and how that's driving commodity pricing, especially gas in Europe, and so to ensure that we've got sort of longer term self-security and sustainability of alternative sources of energy is going to become critical. And I think the world is really coming to into focus on how important that will be, and it will only fuel the sector even further.
Sam, smaller clean energy stocks like ITM Power and Ceres Power, they've been especially hard hit, certainly since they peaked a year ago. Why is that, and should investors stick with them?
I absolutely do. I think I do see some material upside for both of those companies. ITM, for example, I think they've lost around 40% year to date, which is clearly as a result of some of the other issues that I mentioned from your first question. But also, a lot of equity markets a lot of froth has come out of the markets year to date, and a lot of that has been pinned down on interest rate rises and all the issues associated with that, and whether it's more compelling to save capital or invest in fixed income and credit and so on. So we have seen a drop off, especially in sort of new energy as well as tech stocks over the last 3 months or so. In terms of ITM Power, for example, I think we're entering a phase where they are compellingly cheap in our view, but in terms of where we see the longer term growth within the company, they ended 2021 with a gigawatt of capacity, but there's a view to get to 5 gigawatts, or at least 4 by 2025. If you look towards 2030, they've got a compound annual growth rate potential of 85% and annualized revenues from 2030 of around £1 billion as we sit today. So that could clearly grow quite exponentially. Over the last 4 years, the company has raised around £500 million in terms of equity, and around half of that will go into some growth projects just to get them to where I said the 5 gigawatts of capacity. So there is significant growth potential and quite stable funding outlook. So I can't see a huge amount of equity dilution, so there's less risk on that level. So I do think that it certainly is, especially at the current valuation, a fairly strong buy. Very similar with Ceres. I think they've underperformed as we know, but that only makes the outlook and the potential equity investment that much more compelling for that particular company. I'd say the recent partnership with Bosch and Weichai that they announced quite recently is probably one of the most standout elements of the year to date for the sector, and it could see them penetrate the all-important Chinese market, which clearly has huge potential for them. And also sort of closer to home, they're investing, I think, around £89 million into a manufacturing facility, which could be 6 times larger than ITM's one. So there's a lot going on with Ceres and quite a positive outlook for them.
Now, the oil majors are generating plenty of cash from high oil and gas prices. They're also selling unwanted assets. So apart from dividends, lots of that money is being pumped into renewable energy projects. So are you convinced by that strategy? I mean, should the big oil companies split into separate businesses, perhaps fossil fuels and renewables?
It's a very interesting question. It's one that's been posed to all of the majors over the last 6 months to a year. We saw one of the major investors in Shell, for example, that's Aberdeen, sort of lobby that it should be carved up into renewables as well as fossil fuels. Although there is a bit of overlap between the two. I'm a bit on the fence on this particular question because I can see merits in both strategies. But what I would say is that the majors probably will lead the way in terms of the future of green energy development and clean energy, and potentially will end up as a fully green entity or fully green entities in their own right. In terms of Shell, for example, they announced last year in their sort of green energy proposal going forward and how they're going to sort of adhere to that ESG compliance that we discussed earlier. And yes, they intend on growing the green energy side of the business quite significantly. They, in fact, overall, in terms of their output, they intend to grow it by 100%. But if you actually look into the weeds of their proposal, they're actually looking to maintain or slightly increase current fossil fuel production, both on the oil and gas side. So essentially what they're doing is doubling the size of the company, but actually bolting on a greener energy platform to that. And I think that's where the world's going. In terms of having to finance the green side of their future, I think it's a requirement to have the fossil fuel-led production. I don't think it's going to be as simple as turning on and off a light switch. So we move from fossil fuels straight through to clean energy. I think that's, and I think the world is slowly waking up to that with commodity pricing where it sits today. So in terms of on balance, I'd probably think the majors will have to, for the short to medium term, have to stay where they are in terms of growing the greener side of the business alongside their blacker or fossil fuel led side of the business, and then maybe one day in the future split that into separate entities as and when they achieve the goals that they've initially set out. In terms of where we are with the sector, I think the companies pay very healthy dividends, as we all know, and they'll be getting healthier and healthier as we saw with the results from BP and Shell over the last 10 days and how they're increasing their dividends. And many of the smaller players and independents like Genel Energy and Gulf Keystone Petroleum are also increasing their dividends on the AIM market and the FTSE 250 respectively. So in terms of where they are with that, they really do need to retain their increasingly greener investor base. So the likes of Shell, BP, Total, Eni, they've all got large financial institutions on their register, which are income only based effectively, and to ensure that they appease those, they don't lose them. Given the new ESG requirements that is in the market, they have to ensure that they have a very healthy dividend, so that they can justify, so that those financial investors can justify to their investment committees why to hold fossil fuel-led businesses. So I think we'll see healthy dividends, for the remainder and going on into the future. But to ensure that they can finance a greener side of the business, as I say, they'll have to have clean energy and fossil fuels coexisting.
For investors wanting to invest in renewables, and there are lots of them, what's the best way to go about it? Any stocks that you particularly like?
Well, I think in terms of approach, it really is individualized. What I would say about clean energy, it's fairly fragmented. You could go through the wind route, the solar route, hydrogen, fuel cells, or you can have a basket of all of the above. But in terms of approach, I suppose that would be tailored to the individual investor and where they see growth. I personally see growth in all four of those pillars, probably more so on offshore wind at the moment. So I think that's quite a good way to look at to play the market in terms of future energy needs and ability to execute those particular projects, like Vestas, for example. I think is quite a strong buy. In terms of companies that I personally looked at recently, and SP Angel have been involved in, is a company called Atome Energy, which was listed in December last year, so a fairly new entrant to the market, and it was listed as the first green hydrogen and ammonia business on the London Stock Exchange. It's quite a compelling investor story. The company operates in Paraguay and Iceland, and they're looking to build energy capacity through green hydrogen and ammonia production in both countries. In Iceland, they'll be looking to build up to 150 megawatt capacity plants. In Paraguay, that's exponentially higher at 250. And the company has successfully signed some MOUs in both countries with governments as well as leading surrounding players. The two countries are quite ideally located close to existing infrastructure, and also in close proximity to the energy requirements as well. So that is quite a compelling investment story, in my opinion. The management team are very able. It's led by the CEO Olivier Moussat, who has a strong background in the space, as well as Peter Levine, which some of your listeners may know from President Energy. Originally, they raised up to £9 million at the IPO, 6 of which has already been placed in terms of equity, and then Peter Levine's investment vehicle will extend another £3 million as and when that's required. So very well funded. The next catalyst for them will be FID, which we expect within the next 9 months. If you look on the capital availability, they've got around 18 months of financial headroom, so they're very comfortable in that regard. And in terms of where the shares have performed, we've discussed earlier during this meeting with regards to, there has been a lot of froth being taken out of the market, and Atome has been no stranger to that. What I would say is that they've probably suffered half of the loss than some of the companies we've discussed in terms of ITM and Ceres Power. So I do think there is a compelling investment opportunity at these levels. I personally think it's ridiculously cheap, and there are a number of catalysts for that company as we move into sort of Q2, Q3 this year, and then they'll start looking into building and ramping up as and when they get to FID, and that opens up a number of doors in terms of infrastructure financing, which, as we discussed, is fairly plentiful for projects such as these. So certainly is on the upper end of my investor criteria.